This is Multnomah Group's market commentary for the third quarter of 2024. I'm Karen Sanchez, a senior investment analyst with the firm. We lead off with inflation, jobs, and the Federal Reserve. The Federal Reserve's preferred measure of inflation is the Personal Consumption Expenditures Index, excluding food and energy, also known as Core PCE. Through August, the most recent month available, Core PCE was up 2.7% from 1 year ago. Citing softening inflation and ending months of speculation, the Federal Reserve decreased rates by 50 basis points at their September meeting. This brings rates down to a range of 4.75 to 5%. The current Fed forecast allows for at least one rate cut remaining this year, with meetings to be held in November and December. One sticking point to the Fed's rate decisions has been unemployment. In September, unemployment came in at 4.1%, in line with the prior quarter. The Fed continues to be mindful of the balance between interest rates, inflation, and unemployment. We move now to economic growth and the consumer. Second quarter gross domestic product came in at an annualized pace of 3%, an increase from the prior quarter when GDP rose just 1.6%. The second quarter rise reflected increased household spending, private investment, and government spending, partly offset by lower net exports. The typical news headline measure of inflation is core CPI, the Consumer Price Index excluding food and energy. Core PCI differs from core PCE in many ways. One primary consideration is consumer locations. CPI uses urban consumers, while CPE uses surveys of all areas. Another key differentiator is the price weightings used in index construction. Core CPI came in at 3.3% for the 1 year through September. That is unchanged from the prior quarter. The surveys of consumers from the University of Michigan gauges consumer sentiment on personal finances and the short and long-term health of the economy. October's report shows a year-over-year rise in the index of consumer sentiment, up 3.4%, reflecting consumers' experience of softer inflation. The University of Michigan researchers noted that many consumers' expectations are rooted in the outcome of November's elections, which may be reflected in the difference between current conditions and long-term expectations. Consumers' short-term expectations declined 11% over the 1 year period. However, expectations for the long run were up 13.2% over 1 year ago. Turning now to fixed income markets, the U.S. Treasury yield curve as of September 30th is reflected in the blue line on this chart. The yield curve has been inverted for over a year, with short-term rates exceeding long-term rates. However, this quarter saw the beginnings of a normalization in the curve. The yield on 2-year treasuries was 3.7%, for 10-year treasuries 3.8%, and for 30-year treasuries the yield was higher at 4.1%. Turning to fixed income market performance, the Bloomberg U.S. Aggregate Bond Index returned 5.2% in the third quarter as all sectors posted gains. Developed international bonds posted the highest return for the period, up 10%. Cash posted the lowest return, up just 1.3%. For the 1 year period, the aggregate bond index returned 11.6%, led by emerging markets debt up 18%, and the long government credit up 17.2%. Cash posted the lowest return, up 5.5%. Next up is the equity markets. U.S. equity markets saw good performance during the quarter, in which the broad market index, the S&P 500, returned 5.9%. Returns were led by defensive sectors, utilities up 19.4% and real estate up 17.2%. Energy had the sole negative return for the period, down 2.3%. Over the 1 year period, the S&P 500 was up 36.4%. This reflected strong performance from the technology sector, which was up 52.7%. The communication services, utilities, and financial sectors also outperformed the broad market. Energy, while positive for the period, lagged the broad market by 35.6%. The Magnificent Seven stocks, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, continue their growth journey. On this chart, the Magnificent Seven are represented by the dark blue line. Since January 20th, these 7 stocks have returned 407%, exceeding the performance of the S&P, the orange line, by 327%. Over the 1-year period, Alphabet and Tesla have lagged the S&P 500 index by 9% and 32% respectively. However, Nvidia and Meta outperformed the broad market index by 142% and 55% respectively. Emerging markets and developed international markets outperformed U.S. equity by 2.7 and 1.6% respectively during the third quarter. For the 1-year period, U.S. equity markets led, returning 35.2% compared to emerging markets at 26.5% and developed international equities at 25.6%. On a regional basis, Asia's emerging markets led returns for the quarter, up 9.6%. For the 1-year period, EM Asia was up 30.2%, leading all international returns. Latin America's markets dragged down emerging markets' performance, returning 3.9% for the quarter and 3.4% on the year. Here follows our outlook. The Federal Reserve's dot plot, a projection of future Fed funds rates, anticipates rates coming down to 4.4% by year end and returning to a steady state sometime in 2026, settling in at about 2.9% for the longer run. As we see rates change, we are reminded of how sensitive bond market pricing is to changes in interest rates. Based on average duration as of September 30th, each 1% decline in interest rates would likely result in a 6.2% increase in U.S. Treasury prices, the bar on the left. U.S. investment-grade corporates would likely see the strongest increase in pricing, estimated at 7.3% based on September 30th market data. Bond market speculation on the timing and size of a second cut this year could lead to some short-term volatility as we approach the Fed's final 2 meetings of the year. As we approach year-end, there are market uncertainties with the U.S. presidential election ahead and the possible expansion of geopolitical tensions. Congress passed a continuing resolution in September that kept the federal government in operation past the elections. However, negotiations must resume by their December deadline. Congress's negotiations will be tense given the rise in the federal deficit. The 2024 deficit stands at $1.7 trillion. As a percentage of GDP, here the orange line, debt stands at negative 6.1%. Consumers are still in a strong position. Wages are increasing at an annualized rate of 3.9% as of September. Consumers are seeing core inflation continue to come down. The orange line here shows that prices for core goods such as housing, transportation, and personal care items, and excluding food and energy, have actually decreased by 1% on an annualized basis, and prices on services continue to ease. Household net worth has increased sharply coming out of the pandemic. Total household net worth as of the second quarter stood at $163.8 trillion. Household debt as a percentage of income has also increased over the last 3 years. However, it is still below the historical average. This concludes our third quarter market update. Thank you for listening.